In today's video, I'm going to show you how to get a better rate. And that's for both if you have a mortgage or yet to get one. So whether you're a first home buyer or an avid investor, I'm going to walk you through the exact strategies with what you can do today to get a better rate. So stick around and keep watching until the end. And if you end up liking this video, consider subscribing. It's free and you can always unsubscribe. Thanks and enjoy the video. 1. Put in a higher deposit. The first step in getting a better rate is by putting down a bigger deposit. This can either be achieved one of three ways. That is, guarantor, savings, or equity. Let's break each down. Guarantor. This is the type of loan which allows you to buy without a deposit. You'll get a better rate because essentially your loan to value ratio will be less than 80%. And by allowing you to get this lower loan to value ratio, you can access interest rates in this LVR bracket. Savings. This also includes things such as gifted money, shares, sales of assets such as a car or Bitcoin. The more of a deposit you put down, the lower your loan to value ratio. This essentially means that you represent a lower risk for the bank, and as a result, you get a better rate. So much like before, the lower your loan to value ratio, the better the interest rate we can get you. And shortly, I'm going to show you how much of an impact this will have on your interest rate. So stay tuned. Equity. And this is like a guarantor loan, but the difference is that the property will be your own rather than someone else's. The same principle applies here. So essentially, it allows you to leverage another property and thereby reducing your overall loan to value ratio. Ultimately, these are the three levers that you'll be able to pull to help reduce your loan to value ratio. But what does this do and what does this mean to your interest rate? Let's take a look at how this plays out in the real world. Now, for simplicity's sake, I've compared apples with apples, as once you're over a certain loan to value ratio, many lenders are unable to offer certain products. Most commonly, fixed rates. Therefore, to show you how the deposit impacts your interest rate, we'll elect to compare a standard variable home loan, which is available in all categories and gives us the ability to compare like for like. Firstly, looking at loans at a 98% loan to value ratio, including mortgage insurance, we can see that options start from 3.59%. For a first homeowner in Queensland, buying for $500,000 would mean you'd need roughly $33,000, all things considered, and this takes into consideration not only what's needed for your deposit, but also the associated fees with the purchase. Moving on to the next, we have a 95% loan to value ratio, including mortgage insurance, and much the same as the previous scenario, we're going to need that $45,000 in way of a deposit, and the difference being about $12,000. Let's see how this makes. It essentially allows us to reduce the rates on offer from 2.79%. That's a whopping 0.8% difference, and based on a loan amount of $475,000 over the term of over the 30 years, it adds up to be over $70,000. How crazy is that? So there you can see how a higher deposit will actually reduce not only your loan to value ratio, but also your interest rate. And here are three things you can do to implement this to get the most out of it. 1, when you're buying, always aim to have a minimum 10% deposit plus costs. This is where all the magic happens. 2, if you're a first home buyer, approach your parents to see if they'd be open to being a guarantor or whether or not they'd be willing to gift you some monies towards your deposit. 3, if you already own a home, find out your current loan to value ratio. through having the bank arrange a valuation of your home. If you had bought with a minimal deposit, you might find that your loan to value ratio has actually decreased from plus 90% to now under 80%. This will give you leverage, and if you stick around, I'm going to show you how you can get a better rate from your bank with some actionable strategies. So keep watching. 2. Get a fixed rate. At the moment, an easy way to get a lower interest rate is to go for a fixed rate. By and large, you'll find that there's between a 0.2 to 0.8% difference in the current variable rates on offer, and it's something you should seriously consider if you're looking to get a better interest rate. But know there are limitations when it comes to fixed rates, including break fees if you leave early, limitations on the additional repayments you can make on top of the minimum. And to find out if this is the right thing to do for you, answer these 2 questions. 1, are you planning on making extra repayments on top of your minimum? 2, do you expect to refinance, sell, or pay down a large sum of your mortgage within the fixed term? If you answered yes to any of these questions, then you'll want to talk to your banker or broker to either get a split fixed and variable home loan or to find out whether or not a lower fixed rate is really the right option for you. 3, simplify what you do. There are so many factors which can affect your home loan interest rate, and here are a few which can impact the products available. Construction. So if you're looking to build your new home, know that many different banks offer different products for construction loans, from not allowing you to get a fixed rate until the construction is completed to needing to take the bank's package to enable a construction home loan. So if you are looking to get a construction loan, just be mindful. Interest only lenders will charge more if you elect to pay an interest only facility, and this is a type of loan which doesn't pay your mortgage off. So they do and will charge a little bit of a premium for this. Keep that in mind. Investment. Yes, if you're looking to buy an investment property, these rates will be higher than their owner-occupied counterparts. So just be mindful. Self-employed. Typically, if you don't have your financials up to date, it might mean you need to apply for something known as a low documentation home loan. So if you do go down this path, know that it does come at a price. And finally, non-conforming. So if you have issues with either your repayment history or have a default listed against your credit file, you may need to approach what's known as a non-conforming lender. They offer home loans to people where traditional banks won't. And if you do go down this path, know that they do charge a higher interest rate. Now, to simplify your situation, you want to aim to do these 3 following things. Firstly, pay principal and interest repayments where possible. If it's your home, then you should always be looking to do this. Secondly, if you're self-employed, make sure your financials are up to date and the most recent year's tax return is lodged. And thirdly, keep on top of all your bills. Make sure you pay them on time and get a copy of your credit file. Make sure there's no issues or defaults listed. If there's any inaccuracies, make sure you correct them. 4. What to do when you have a mortgage. Okay, great. Now you know what to do to get a great rate before you have a mortgage. Now let's look at the steps to follow to keep it sharp. The first thing you want to do is call your bank. And it's best to do this on a private number. This will make more sense in a moment. Once you're on the phone to the bank, make sure you're in their home loan sales department. You want to pretend you're a new customer and find out what their current rates they're offering to new customers. Take note and aim to get a reference number for the call. Great. Now we move into the next step. The next step is to call them again, but this time you'll want to unblock your caller ID. Get through the bank's home loan retention team or maintenance department, and from there, you'll tell them that you're looking for the bank's discharge form. At this point, the banker will ask, why you're looking to leave. To which you reply that new customers are getting better interest rates than the one you're on. Using the reference number you got from before, share this information and tell them to match this rate or you're out of there. Now, if they don't match the rate, you want to get the bank to prepare the discharge form. This is essentially telling the bank that you're leaving them. At this point, you want to reach out to a mortgage broker so that you can get help comparing the market and making sure that that refinancing makes financial sense. A great broker will first look at if you'll need to pay mortgage insurance, because based on your loan to value ratio, it may be applicable. They'll then consider all the associated costs, including whether or not there's any break fees. From there, they'll calculate the savings you'll receive by refinancing. That is the difference between the interest rate you're getting on a lower rate, any rebates the lender's offering. These are typically ranging from $2,000 to $4,000 at the moment, and it's essentially the bank paying the cost for you to switch your home loan. And once they're done, your mortgage broker will be able to tell you very quickly if it makes sense for you to refinance. And once this is all done, they'll very quickly tell you whether or not refinancing makes financial sense for you. And there you have it. Remember, if you like this video, feel free to click that subscribe button. Here at Hunter Galloway, we get home loans approved. So if you live in Australia and looking for a mortgage broker, we can help. Visit us online at huntergalloway.com.au or call us on 1300 088 065. Thanks for watching, and I'll catch you next time.